Hey, good morning, everybody. It is Thursday. It's Thursday Morning Live. And no matter where you are listening in from, it is good to have you here this morning. Hey, if you're new to this show, I appreciate you being here. And this morning, I think we're in for a little bit of a wild ride. I have a good friend of mine on, Kevin Cook from northern Wisconsin, and we're going to talk about the markets. We're going to talk about the Fed rates, and we're going to share a Fed tool with you that may be beneficial in what you're doing. Anyhow, before we get started, how's your week going? Are you being intentional about your work week, what you're trying to accomplish? Are you setting those goals for yourself? I know that even for most of us, that we need to be really intentional about what we're doing and how we're building for the future. So, people are talking a lot right now about the markets being crazy and things being upside down. And I actually put a post out on Twitter this morning that just said, the biggest winners in this market are going to be the ones that take the opportunities that exist out there today. And so, real estate is cyclical. It goes up and it comes down and it goes back up again. And we are definitely on the downside of that cycle right now. Those cycles can last anywhere between, you know, 5 years, 8 years. I've even heard as much as 16 years, which I don't think they last that long. But if we're going up and then we're coming down, we're about 3 years into the downside of this thing. And we don't know when it's going to turn. It could turn today. It could turn in 2 years from now. But anywhere now that you get involved in the real estate cycle, what's going to happen is you're going to be in position to take advantage of the next bull run. So I want to see you there, and I want to see you make those accomplishments. Hey, my guest this morning is a friend of mine that, we met a couple years ago now. I was doing some speaking events up in Wisconsin, and Kevin and I met each other. Kevin is a smart guy, so he's going to bring some good information to us this morning. Let's bring him in. Kevin, good morning.
Hey, Mike.
How are you? Good to see you again.
Excellent, excellent. Good. Thank you.
Always good to run into you and bump into you. So, how I understand that you got a little bit of snow up north.
Yeah, I came up to the North Woods, almost to the Upper Peninsula of Michigan, and I had to check on my house up here, some issues I had, and we just got a mini snowstorm
Wow.
yesterday, and not a ton of snow, but it was pretty high winds, and it seemed like it was the middle of January again.
Yeah, that's crazy. Yeah. So I moved in January to California.
Oh, neat.
So I'm not. I had to quit sharpening my snow shovel and move on. It got to be too old for me already, and
Right.
just kind of tired of the snow and the weather. I talked to my sister this morning, and she's in northern Illinois, and I guess they got whacked a little bit too yesterday. So you know, just not missing it at all. That's for sure. So.
Yeah.
Hey, listen, as I always get started on Thursday mornings in my podcasts, I always ask people one question. And, I always want to know in one word, Kevin, what describes you personally and professionally?
One word. Do
Yeah.
you know how hard this is, Mike? But
Yeah,
I know you
I
love to
do.
do this.
Because you love to talk too. So,
Exactly, yeah. So my word would be curious.
mm, okay, great. What makes you curious?
I just growing up, I just had so many questions about the world. I grew up watching Carl Sagan and Cosmos, and then I went into a study of religions. Not just Christianity, but I wanted to know about all the world's religions, why people believe what they believed. And then I would go in and out of science and just trying to understand the world, and that hasn't changed in like 40 years. I'm still that way.
Yeah. Yeah. So, something about research for you, though, huh?
Yeah, I mean, I just there are people who are like I'm not that smart. There's physicists and biologists who are doing incredible things. Um, I'll never be able to have their level of knowledge or do what they do, But to even try and understand what they've discovered in physics or biology is just amazing to me. And then
Right.
explain it to kids. Part of the backstory here is that when I was a teenager, I was allergic to algebra. And so I'm on a mission to inspire 1 million teenagers to discover their passion for science.
Hmm. That's awesome. I love that you say you were allergic to algebra because I can remember being in high school, and I love that. I tell this story because I love it. But being in high school, I would argue with my math teacher about I'm never going to use this shit, right? I'm never going to use this, and he would say, "Yes, you will. Someday you're going to use it," and he was right. You know,
Yep.
I hated math growing up. I hated math when I was in school, but you know what? I use it every day now. And the thing that we know is that math doesn't lie, right? It's all in
Right.
numbers. So it really tells the story. And I always like to look at it from a standpoint of, hey, we've got three ghosts. You got the ghost of the past, just like if you were watching the Christmas Carol, right?
Right.
You got the ghost of Christmas past, the ghost of Christmas present, and the ghost of Christmas future, and that's what math does for me, you know. And when we look at deals and look at opportunities, but hey, why don't you give a little background about who you are, what you do, and what you're currently working on today?
So, speaking of math, I had to teach myself probability and statistics in my 30s because I walked on the trading floors of the Chicago Mercantile Exchange and just fell in love with the markets. I became a currency trader at a high institutional level, was trading like $100 million a day, did that for about 10 years. And then during the financial crisis, I got a chance to teach options, and I just love options. And there's a lot of cool math with the Black-Scholes model and that kind of thing. Then I got more interested in what public companies were doing, and I saw that wealth was created by investing in public companies like Microsoft or Celgene. I love technology and biotech, and so I went to work for a firm called Zacks Investment Research, ZACKS.com. You can find them there. And what we do is we have a proprietary model to look at earnings momentum for companies. And then we pick stocks for people. We don't manage money, but we create model portfolios. And I've been doing that for now 12 years. And one of my funnest things was discovering the company NVIDIA and artificial intelligence. And we bought the lows back in October, and have really nice gains there. And it's just a company I believe in. I understand enough about what they do with GPUs, graphic processing units that create artificial intelligence, that I've just held onto the stock. People ask me like, well, what's a GPU and what's AI? I say, think of the desktop computer that you've always had, or even your laptop. It's got Intel processors. And it used to be like a 2-lane highway going back and forth. Now maybe it's an 8-lane highway. It's serial information transport. Well, that's what CPUs do. GPUs are like 100,000 piano players all playing at once to process information. And that's why it's accelerated computing. And you just see the demand for this type of thing since the explosion of ChatGPT. It's just going crazy.
Yeah, is ChatGPT the better platform that's out there for AI today?
Well, it's one manifestation that became so widely publicly available. Like it's so easy. Anybody can go and create an
Yeah.
account and ask the computer a question, and it just keeps getting better, and you can get better at using it, how to prompt it. So it's just one manifestation of what's called a large language model that's run by these massively parallel architectures with GPUs. But the big companies are doing so many things. Like the reason I love NVIDIA and the founder, Jensen Huang, is because he looks at the scientific applications. So you've got universities and research labs doing physics and biology, that are, basically, plumbing the depths of the universe and either discovering new galaxies, or they're discovering new drugs and cures to disease using
Mm.
this computational power.
Wow, it's crazy, and the one thing that's so interesting to me, and I heard this comment, I don't know, maybe a year or so ago. And I think I knew it, but it just really made sense is the fact that technology changes at a rate of or doubles at a rate of every 2.5 years, it doubles. And if you look at where we're at today to where we are going to be in 5 years from now, I can't even imagine how much AI will benefit us in a lot of what we do. Even like what I do, right? Market research and looking for data, and as they continue to update and increase, um, you know, it, beyond just using it to help you write, text for a post or something. So,
Yeah, huge opportunities.
hey, let's talk about finances, markets, where you see the markets today, where you see us headed. Not just in the stock market, but I know you've done a bunch of research on some of the bad debt out there and banks, and what do you see happening?
So, I really thought that last year when we had that regional banking crisis, let's go back 1 year, that it was going to be very bad for the economy and for real estate. And look how the market shook it off. And it just confirmed a sort of a pet theory I've had for years about how the stock market can shake off bad data and even new black swans. And it's like investment firms are so sophisticated now using big data, like we're talking about, to process information quickly and then make their next moves, that we don't get big protracted drawdowns anymore. I mean, look at the pandemic shutdown during COVID. That was we had a flash recession, a flash crash,
Right.
and boom, we're right back up. And the markets just shook off the regional bank crisis of last year when we had those banks implode. So the market is so good at processing information because it's a collective thing. It's not, I say the market, but it's thousands of institutional investors managing trillions of dollars using economic models, and their bias is to be long something, is not to be in cash, but to either be buying stocks or real estate, and they keep doing it. So I defer to experts like you, like where is this commercial real estate crash that everybody was expecting, and should we
Hmm.
still sort of expect a downturn because lots of debt was financed at say 3% and now has to be refinanced at 6 or 7%? So what do you think?
Yeah, I love that comment. Where is the commercial real estate crash? Here, uh, I mean, really, and I've been saying for a year and a half, I think it's going to be a soft landing. And if you listen to some of the economists within the walls of the real estate world, they're saying the same thing now. Somebody I really admire is a guy named John Chang at Marcus Millichap, and he started saying just a few months back that it's not going to be as bad as we expected. And there's some sectors that it's bad, retail for sure, office for sure, and
Office, yeah.
not every market, but the housing markets, multifamily, people need a place to live, people need a place to stay, and so those markets are going to be good. The concerns, I think, are the trillions of dollars of bad bridge debt, floating rate debt that's out there. That's where the problem lies. And some of what I see is that, you know, first of all, I don't think a lot of those deals will make it to the street. There's going to be insider trading. There's rescue capital out there today that's going in and picking these deals up before they ever even get to a point where they hit the street. And insider trading. The lenders are calling up experienced operators and saying, "Hey, we got a deal in trouble. You want to buy it for par?" So the you know everybody's saying, "Oh, yes, there's blood in the water, but how bad is it going to be?" I don't think it's going to be that bad. What are you seeing?
Well, Mike, can I ask you, when you say insider trading, you don't mean the illegal kind that happens on Wall Street. You just
No.
mean that deals get done behind the scenes.
Yeah. So here, I'll give you an example, Kevin. Exactly. Thanks for clarifying that, because it's not insider trading, right? But here, so the first time I saw this happen, year and a half ago, one of the first multifamily deals in Houston fell. It was about 3,000 units. That deal never came to the street. Very little news about it, other than the fact that it imploded. And Freddie, the lender, calls up, an experienced operator, and you know that experienced operator had the opportunity to buy that deal. And that's the kind of insider trading I'm talking about. So the lenders are calling up experienced operators saying, hey, we've got a deal in trouble, do you want to buy it? We'll sell it to you at par, below par, and moving forward from there.
Excellent. That makes a lot of sense. I have an emerging theory. Remember how in after the financial crisis, like you really started to see it around 2012, private equity like Blackstone was coming in and buying single family homes. Remember that?
Yep.
Okay, so now we have a situation where office is decimated. I just saw another default. I forget what town, but some big office REIT defaulted on a $78 million loan because it was like new construction and they can't lease it. They can't find anybody to take it. I'm wondering if those office investors, those pros, will start to move into multifamily because office is so decimated.
It's funny, when all this started, I saw a lot of multifamily people start to go into other sectors, self-storage, industrial, warehouse, right? And I'm pretty focused on what I do. I love multifamily. I love bringing a good value add product back to the market. And y- you know, I think you're going to see people always shift between asset classes because something else looks attractive. I almost consider it to be, shiny object syndrome sometimes, Kevin, to be honest with you.
Yeah. Yeah. Well, but investment capital, like they sort of have to make a forecast. And it's
Yeah.
like, does anybody really see office coming back that much? I don't know. But they have to forecast that. And then just like when Blackstone moved into single family houses, which was, surprised me. Nothing would surprise me now.
Yeah. Right. Right. So
Hey,
what is the Fed?
you want to talk about interest rates in the Fed? Because I got something cool
Yeah.
I want to show you.
Yeah, absolutely. Let's talk about the Feds and interest rates and what Mr. Powell is going to do.
Yeah. And we like Mr. Powell is the figurehead, but really, there's a dozen economists that he works with, and he can drive the consensus or drive the debate, but they really make that FOMC, the Federal Open Market Committee, really makes a joint consensus. And what I'd love to show you is how anybody can use the CME FedWatch tool to understand where rates are going to go instead of reading the headlines of, inflation was higher, so the Fed's not going to cut this year, or the PMI was lower, so the Fed is going to cut. You can look at the forecasts using the CME FedWatch tool. Can we show that?
Yep.
All right. If I'm going to go and play on that screen, and
Sorry, my bad.
hopefully that's all right. So
Hang on, I can't
I
figure this
heard
out. There we go.
you got it. Okay, great. So I've heard people recently say that, the CME FedWatch tool is just some survey that tells you where interest rates might be, but it's much deeper than that. It's actually where the market prices of interest rates are trading. Like, we're all familiar with the commercial paper market, right? It's the 90-day market for where corporate finance officers want to handle their cash balances, whether they need to lend or borrow. So corporations are doing that. Banks are also doing that. And the T-bill, the 90-day T-bill, is sort of a gauge of that. But the CME FedWatch tool is a super deep and liquid market for this. So let me scroll down and take a look at this. So can you see that? Can you see that big blue bar that says there's a 93.2% chance of interest rates staying right where they are? This is the Fed overnight rate, staying right where they are in the target range of 5.25% to 5.5%. Can you see that?
I do see it. Yes.
Great. So that's there's a meeting May 1st. There's a Fed meeting every 6 weeks, and so this is a forecast, and it's not just a survey. It's based on billions, if not trillions of dollars that are moving in the commercial paper market and the bank short rate market for forward rate agreements. You mentioned floating rates before. This is, every bank, every corporation has risk of either I need to borrow or I need to lend. Do I do it fixed or do I do it floating? And so remember, Fed funds is the overnight rate, which the Federal Reserve uses as this target. Like, hey, if you're a bank and you need to get your reserves up, you can borrow at this rate. And banks, say JP Morgan has excess reserves, they can lend at that rate. So this is going on every night. So this is how things look for the May 24 meeting. This tool has this page has multiple tools. So now I'm going to click up here. Let's see. So you can see at the top, we're on the next meeting. So let's go to the June 12th meeting and see what the probabilities look like. All right, now things get interesting. Now we shift to a 61% chance that the Fed is going to cut. It's not a certainty, but it's the way the market is positioning, meaning hundreds of banks, thousands of corporations, all dealing in short-term paper for borrowing or lending, are positioning their hedges. They use the Fed fund futures market as a hedge, and it's indicating that they're leaning towards a 61% chance of the Fed cutting in June. And we'll look at one more, and you can see.
They think in June that they're going to cut rates.
Yes, but they don't just think that. They're also positioning all their hedges that way. So I'm talking about trillions of dollars in hedges are positioned. So it's showing you what the market says where the rates will be. Now let's see what July looks like. July, now you start to get into, oh my gosh, there's greater than a 1 in 4 chance in July that we're down under 5%, meaning the Fed will have made 2 cuts. So there's a 26.4% chance that the Fed will cut 50 basis points in the next 2 meetings after May. So by the July meeting. So you can keep going on this and see what things look like.
Yeah.
You can also get a quick look at all of them right here. This is the meeting probabilities about where rates will be. So blue is kind of showing you where the central probability is for where rates will be, and you're looking out to next spring of, right now the way the market is positioned on these forward yield curves. These are actual yield curves, but they're forward yield curves for short-term paper, short-term money, 90 days. About almost a 30% chance that will be at 4.5% a year from now. So that's the way the market is positioned. Now, what about the dot plot? Everybody wants to know, well, what does the Fed say? Well, I want to just make sure people understand that the dot plot is completely different than the FedWatch tool. The dot plot is basically forecasts by the FOMC members about where they believe rates will be. And there's about 19 members that can contribute to this, even though they're not all voting members. Let's say there's a dozen voting members on the rate, but there's 19 that can contribute. And so you can see that there's a bunch of this is by year. For the year 2024, the bulk of Fed economists are between 4.5% and 5%, where they think the average rate will be. So they see rates coming down, and that's why the real market, which you can see on the CME FedWatch tool, has moved down into that area. And then you look out to 2025, the bulk of the Fed economists are between 3.5% and 4%. Hey, this looks good for real estate. But remember, these projections are forecast by each individual Fed economist, and they remain anonymous in this, is based on today's data. They're saying based on the trends they see in employment and inflation, that this is where they think rates will be. And remember that those are the Fed's mandates, right? Is
Yeah.
Full employment and keeping inflation low. So basically, they all see they see inflation coming down, but they also see the tendency that maybe growth and employment have peaked, and that that they will need to be softer on policy to, sort of smooth things out for the economy as we roll into 2025. So thanks for letting me share that.
Yeah, no, I appreciate that. And can you tell people how they get that if they want to go get that Fed tool?
Oh, sure. So I'm just going to go right back to the CME FedWatch tool. It's so easy to find. I mean, if you just typed in on Google CME FedWatch, it'll be the top result.
Okay.
It'll be the top result. And, so like you don't need to memorize this long URL, CME Group, markets. You just put in CME FedWatch and your top Google result will be this tool. And it's really fun to play with, and it helps you see where the real market is at in forecasting. I mean, and I say forecasting isn't even accurate. It's really where the banks and the corporations have put their money in hedges because they have borrowing or lending risk, fixed or floating.
So listen, we're kind of bumping up against time here, but I have a couple quick questions. So based on your research and knowledge, and I first question is this getting artificially manipulated because of an election year?
Excellent question. Now, I've heard many people say that, oh yeah, the Fed has to cut rates because they don't want to, mess up the election. I mean, there can be all kinds of conspiracy theories about that we'll never be able to prove. But this is a body of 19 economists, trying to do serious work, and they have to come to some kind of consensus. And they really are looking at the data. They're looking at employment, inflation, and growth to determine policy. So I don't think it's blind belief to say that they're sincere and genuine in their data focus, and to think that we're going to get a rate cut just because of the election. No, I don't think that, but that's just my view.
Okay, interesting. And so when the Fed rate comes down below 5%, what's going to happen to the market, to the retail rate for the housing market?
I mean, it's gonna move in sync, and as long as there's no other contagion or risk surprises, I think I think you'll see your real estate rates move down too.
So we're seeing that in spring of next year, we should have our rates somewhere down around a full percentage less than where we're at today.
Yeah, I mean, it seemed like in the past few weeks when we had some hot data, like strong growth, strong inflation, that you were going to see mortgage rates go up to 8%, right? But but I think that's cooled down. Jay Powell, spoke the other day, and he wasn't too worried about it. So yeah, you could be looking at mortgage rates, 6.5%.
Yeah. Well, Kevin, I appreciate you being here this morning. Um, I know that you're busy and with your LinkedIn newsletter and your updates that you give. Tell people how they get a hold of you if they want to continue the conversation or learn a little bit more about your research and your market data. How do people get a hold of you?
Sure. So you can find me on LinkedIn. You see that below. Just search Kevin Cook Caveman, and uh, that's where you'll find the multifamily newsletter. Something I started as a novice because I wanted to learn more, and I've learned a bunch from Mike, but I just want to continue to learn. What's a 506B investor versus a 506C, and that kind of thing, and
Yeah.
cap rates and all that good stuff. You can also find me on Twitter if you want to learn about my education initiatives. At Kevin B. Cook on Twitter, the top of my feed has an education proposal of mine. And then at Zacks.com, ZACKS.com, you can see all the stuff I write on NVIDIA. In fact, you can email me, kcook@Zacks.com, and I will send you. I write lots of reports on artificial intelligence, ChatGPT, GPUs, all that kind of thing.
Awesome. Hey, I want to just kind of go back and make one comment. We started this show this morning, and you made one comment. You said, "Where has the housing crisis gone?" And I want people to think about that because really, where is that crisis today? And are we going to be? This is the $1 million question, right? Or $100 million question. Are we going to fail or are we going to increase? And I tell people today, get involved today, take that risk because you're going to be in front of the next bull run. Even if the market goes down a little bit more, you're gonna catch the upside. And that's where you want to be today is catching the upside. So Kevin, thanks for being here. Listeners, thanks for listening in this morning. We appreciate you. We're here every Thursday morning, uh, bringing some interesting content to the market, for you to listen to. So please, if you're following us on social media, like us, love us, help that grow a little bit. If you're on YouTube this morning, smash the subscribe button. And we're always bringing live content, new information to you, educational things that are going to help you grow and further your business and stay in tune with the markets and what's going on. And if you're on Facebook, join our private community at Multifamily Unplugged, where you're always going to be updated. Kevin, thanks for being here. I look forward to seeing you soon somewhere. I'm going to be in Sheboygan in a couple weeks, so I have to get you that date. So hopefully there'll be
Yeah.
no snow when I get there in April or later